Look, most people think starting a housing business requires, millions of dollars just sitting in the bank. They think it's a game reserved exclusively for Wall Street elites, massive corporations, or maybe trust fund babies. But today, we are going to completely shatter that myth. Welcome to The Explainer. Today, we're unpacking the definitive playbook for building a lean, highly profitable housing business in 2026. This isn't about wishing and hoping. It's about pure, actionable data to help you build an empire from scratch, even if you literally don't own a single brick right now. Okay, let's dive into this common limiting belief. It's incredibly easy to look at the housing market and just feel completely priced out, assuming real estate is only for Wall Street billionaires. But the truth is, the rules of the property market in 2026 have totally shifted. Actually, it's the traditional landlords who refuse to adapt that are struggling right now, while smart, lean, and agile housing businesses are making absolute fortunes. So on one side, you've got the old way, right? Massive capital requirements, slow movement, and shrinking margins. But on the other side, we have this new wave of lean housing businesses. And what should really catch your attention here is that some of the biggest, most successful real estate empires in the US actually started with less than $10,000. Less than 10K! That's the power of the modern American housing market when you know exactly how to play the game. To get you there, we've got a really clear, structured roadmap for today's explainer. We'll start with the new housing blueprint, then help you pick your investment strategy. After that, we'll cover where to buy in 2026, mastering leverage and finance, finding deals and building teams, and finally, we'll break down the golden math formula. 6 straightforward steps from absolute zero to a highly profitable housing business. All right, step 1, the new housing blueprint, building from scratch in 2026. To really succeed this year, you need an exact, step-by-step framework rather than just blindly jumping in. Moving right along to step 2, pick your investment strategy, choosing your weapon. See, before you even think about browsing property listings or declaring, I want to buy houses, you have to make a choice. You absolutely need a specific vehicle that perfectly aligns with your available capital and your personal risk tolerance. Now, in the US market, there are 3 primary paths for beginners. First up is fix and flip. This is where you buy a distressed, rundown property, renovate it quickly, and sell it for a massive premium. It's great for quick cash. Second, we have the BRRRR Method, which is perfect for building a rental portfolio over time. And third, house hacking, which is all about living for free and building pure equity. Let's actually break those last 2 down a bit more, because they are incredibly powerful. And this brilliantly illustrates the BRRRR Method. It stands for buy, rehab, rent, refinance, and repeat. It's just a stunningly efficient strategy, honestly, because it cleverly uses the exact same pool of money over and over again. You buy a property, you fix it up to boost the value. You get a tenant in there for income, and then, here's the magic, you refinance it with a bank based on its new higher value. You pull your original cash out and you move right on to the next house. Wash, rinse, repeat. Then we have house hacking, which is, without a doubt, the absolute holy grail for beginners. Imagine buying a multifamily property, like a duplex or a fourplex. You live in one unit yourself, and you rent out the others. The absolute best part, your tenants literally pay your entire mortgage. You get to live for free, slashing your biggest living expense to zero, all while building equity in an appreciating asset. It's a total game changer. Step 3, where to buy in 2026. Market selection is everything. This brings us to a golden rule you have to remember. Market selection determines 90% of your success. 90%! You really shouldn't just buy a property where you want to live. You have to buy where the numbers actually make sense. Right now, corporate jobs and populations are aggressively migrating to the Sun Belt states. Think places like Texas, Florida, and North Carolina. When you're analyzing a US zip code, look for 3 vital green flags. Number 1, diversified job growth that's above the national average. Number 2, continuous population inflow, people actively moving in, which drives up demand. And number 3, a low price-to-rent ratio, which just means the cost of buying the property is relatively low compared to the high rent you can charge. But, just as important as knowing where to buy is knowing where to avoid. You really need to steer clear of markets with strict rent control and anti-landlord laws. Think certain parts of California or New York. Why? Well, because you have to protect your cash flow at all costs. Focus on landlord-friendly states where evicting a non-paying tenant doesn't take 12 agonizing months of legal battles in court. All right, step 4, mastering leverage and finance, using other people's money, or OPM. Now, what's really interesting about this slide is this tiny number right here, 3.5%.
This unlocks the true magic of American finance. The absolute best part about real estate in the US is that you do not need 100% of the cash to buy an asset. You use OPM, other people's money. If you go with the house hacking model we just talked about, you can actually qualify for an FHA loan. This incredible program lets you buy a property of up to 4 units with a tiny 3.5% down payment. Let that sink in. On a $400,000 property, that's just $14,000 out of pocket. That is exactly how you get into the game without millions in the bank.
Now, what if you're doing a fix and flip? Well, for that, you leverage hard money lenders. These are private individuals or specialized companies that finance both your purchase and your renovation costs. And the kicker? They base their loan on the property's future renovated value, not your current bank balance. This just proves that the real secret to a housing business isn't having a massive pile of your own cash. It's knowing exactly how to pitch a highly profitable deal to lenders. Step 5. Finding deals and building teams. Going off market. Look, if you want high profit margins, you have to source your deals correctly. And let me tell you, fresh, good deals are never found on retail websites like Zillow or Redfin. By the time a property hits those public sites, it is already overpriced. To find the real winners, you got to go off market before a property is ever listed publicly. How? Well, you can go driving for dollars, literally driving around neighborhoods looking for distressed or abandoned properties. You can actively search public records for abandoned homes. Or you can work with local wholesalers whose entire job is to target distressed sellers and pass those discounted contracts on to investors like you.
But finding the deal, that's really only half the battle. To scale this business in America, you can't do it alone. You need this 3-person dream team. First, an investor-focused real estate agent who actually understands investment metrics like cap rates and baseline returns. Second, a reliable, licensed contractor who won't just vanish halfway through a renovation. And third, a rockstar property management company. A great property manager handles tenant screening, the inevitable 2 a.m. emergency maintenance calls, and rent collection. They are absolutely key to converting an active, highly stressful housing business into a purely passive wealth-generating machine. And finally, step 6, the golden math formula. Math over emotion. So the crucial point is this: you must never fall in love with the property itself. You have to fall in love with the numbers. Emotions will bankrupt your housing business, but math will make it thrive. Before you ever make an offer, you have to run this 3-step cash-on-cash return formula. Step 1, calculate your annual net cash flow. That's your total rental income minus everything: the mortgage, property taxes, insurance, vacancy reserves, and your property management fees. Step 2, calculate your total out-of-pocket cash, meaning the down payment plus any rehab costs you paid yourself. And step 3, divide that net cash flow by your out-of-pocket cash. That simple calculation gives you a percentage. And if that specific cash-on-cash return number isn't sitting above an 8 to 10% minimum, you must be ruthless, protect your capital, and walk away from the deal. Seriously, in the United States, there are plenty of properties, but profitable numbers are rare. Do not compromise on this minimum threshold. Which brings us to a final question for you to ponder. Are you relying on luck, or are you executing the math? Starting a housing business in 2026 isn't a gamble. It's a completely repeatable framework. It's about finding the right market, leveraging smart loan systems, building an automated team, and running those numbers objectively. If you found this explainer helpful and want to take the guesswork out of the math, drop a comment below saying housing, and you'll get access to a free, exact real estate deal analyzer spreadsheet so you can run these numbers yourself. Thanks for joining me on The Explainer, and happy investing!